We're going to start. Welcome everyone to our monthly webinar here at Management One, Property Management. We're excited to see you guys, and we're anxious to give you some great information tonight. A lot of you have been on prior webinars, so we're going to make the introductions a lot shorter this time. All of you most know that we've been around for 36 years. We've done over 10,000 properties as far as in leased and rehab them. And most of you are getting to know our panel. But for those of you who have not met our panel, I'll just quickly go through it. Kristan Pennington in our marketing department. She has been with us for, believe it or not, just last week for 16 years. So, thank you for joining us, Kristan. Appreciate it. She'll be the moderator as well. And then we also have Kristan Pennington. She handles all the sales and listings in the Inland Empire. And been with us, I believe, 9 years, right, Kristan?
Pretty close.
And then we have Tyler, and yes, he is my son. He's been with Management One going on about 2 years, but he's been in real estate 6 years. Ty handles all the sales and OC and our business development at Management One. So at this point, I'm going to turn it over to Kristan. But before I do, I want to make sure that you mail in your email questions as far as throughout the webinar. It's being recorded, so you don't have to worry about taking notes. So hit us with all the questions that you want. Also, each month, you need to go ahead and sign up for the webinar, even if you can't attend. The reason for that is because as soon as the webinar is over, it'll automatically send you a video. But you do have to sign up each month. So when we send you out the email for sign up whether you can be on the live webinar or not. So with that said, Kristan, take it away.
All right. So as Ron said, you can send in your chats and we'll answer those as we go. And so for tonight's agenda, we're going to hear from Kristan first on the Inland Empire rental, actually real estate market. Tyler will bring us to Orange County. I'm going to talk about raising rents and why we should be raising rents. Ron will be wrapping up our single family home retirement strategy. And then Tyler will end the evening with a rental market update. So having said that, Kristan, you can get started.
Okay, awesome. Thanks, Kristan. So regarding the Inland Empire, well, good evening, everyone. The Inland Empire is still, as you could see from the previous chart, is still a seller's market. Here we have a nice slide that shows us the insane growth that all of our counties have been having in terms of sales price and appreciation. So this is from quarter two of 2020 to the last quarter that closed that we have record of in 2021, and the immense amount of growth in terms of values of your properties. Now, we were discussing outside of the webinar that there are some areas now that are starting to experience a slight, but very slight decrease of appreciation. For instance, Riverside, the city of Riverside, we are seeing that there's a bit more available inventory, and we're also transitioning into the school year and people going back to work. So we are seeing that there is a slight slowdown that translates to 5% decrease in listing price for the homes in our county. So we are seeing a little bit of that, but 5% overall when the houses have grown this much in value and have appreciated so much over time really is just not that impactful as of yet. Moreno Valley has a total of 139 homes on the market today, literally as of an hour ago. So still not enough inventory. Riverside is a little high at 342, but all of my other cities are pretty much selling as they're coming on the market. So if you have any questions, be sure to let me know. I did want to bring up that we do have some properties that are rented that are available for purchase. This is what we call rent-ready inventory. So there's a lot of benefits to that, and we can go into that later. But I did want to put that plug in so that if you're looking at having another investment property, you can reach Tyler or myself, and we'll be happy to let you know what those look like.
Okay, Kristan, so what you're saying is, so between Riverside County and Orange County, you're right at 30% appreciation, right?
From the second quarter of last year to this year, yes.
Yeah. So if you have a $500,000 property, that means it's went up 150,000 to 650,000 in 12 months. Correct?
Crazy, but yes, that's what the data shows.
Well, I think what's important to note here is that when you get into what we call a rocket market like we're in right now, a lot of times people have a tendency to, hey, I just want to sell. But I guess I go back to like the stock market, and Tesla is a good example. The market was around 600-700, and people were selling out because it was at 300, so that it went up 100, almost doubled to 100% to 700, and then all of a sudden it went to 4,000 in like a month. Okay, and I think we should be very cautious, because when you have this kind of growth and you have basically no properties that are being built of any significance, but people are still becoming adults and they have to rent and they have to buy, that demand is still there. So I caution you not to jump on the bandwagon and do what everybody else is doing, and that is sell out because you think the market is going to crash. If we have to go back to 2008, everybody wanted to sell out in 2008. Those people that sold are sorry they did now, because prices are way beyond what they were in 2008.
Yeah.
So they recaptured all that. So just really, really important. This is staggering, ladies and gentlemen, just absolutely staggering.
Refinancing, for instance, we still have a lot of homeowners that have mortgage insurance that, with this kind of growth, you're able to get rid of that, right? In addition, you can actually leverage a little more. So, it really does help. I think some of the price reductions also have to play with appraisals not being able to catch up with the kind of growth that we have. And so there's a lot of other factors, but I'm not going to go on forever, so I'll take it back to you.
All right, great.
Yeah.
Perfect.
So now I'm going to turn it over to Tyler and the Orange County real estate market.
Yeah, thank you. No, all good info. So one of those things that Kristia had just mentioned is, mortgage insurance, the cost of that now that appreciation had gone up, you have equity in your property, you can kind of get rid of some of that, right? What I wanted to talk about, and Kristia did a few months ago, was in terms of forbearance. And a question that I've personally been getting over the past several weeks is, can I still apply, or can I even still get forbearance for my property? And the answer is yes, right? So forbearance is basically reaching out to your mortgage company or your lender to see, under the COVID pandemic, if they can either tag on some of what you would owe in terms of on the back end of your loan, forgive it completely. There's a lot of differences, and not in all cases. I won't say in all cases it is available, but in most cases of what we've seen, it is. But as you can see on the chart, what I just wanted to mention, so 7.2 million homeowners actually took advantage of the forbearance, and this is as of last month, right? So 5.2 have already exited the forbearance program because they've either caught up on the payments or whatever the case was, which is an insane amount of people that actually got help from it, right? Then you got removed and paid off at 1.3 million, which is 25%. And then either removed or slightly delinquent on it is only about 6% of people. And then people that are kind of moving towards somewhat of a potential foreclosure on the property is only at 4%, or only 195,000 people out of the 7.2 million. So if you're looking to get a little bit of help on that, call us, let us know. We can point you in the right direction with a lender if you don't have one or don't know one. So you could really take advantage of this if you in fact are in need of it.
Great. Thanks, Tyler. That's a good information and encouraging that people are able to get the help, but then get back on track.
Yeah, help a lot of people get back on their feet.
Yeah, I'd like to add on there too, because on the 5.2 that have, let go of the forbearance, what I think has happened is people have found out that most residents are paying. Like at Management One, 96% of our residents are paying. And when people first went on forbearance, they were scared because they didn't know, is anybody going to pay, right?
Right.
Now we find out they are. Also, let me point out this. When you tack on, let's say 6 months of payments on the back end of your loan, okay, you're paying that loan off with cheaper dollars because your dollars are going to be less in the future. And I don't want to get into the weeds of it, okay, but it isn't necessarily a bad thing, to be able to pay your loan off down the road, unless you're retiring and you just want to pay it off. So forbearance is a great tool to use so we can navigate through what we're going through here with this COVID-19, which it looks and appears it's not on a way out of town. It's still in town. Okay. And for how long? That's anybody's guess, but we hope for the best on that. So, but any questions from anybody?
Yeah, we do have a question. So basically going back to Kristia, do you feel like this market trend of crazy high prices is going to continue for the foreseeable future?
Yes, I think it depends too on where you are. So you're noticing that the city of Riverside, for instance, is starting to taper off as far as the growth goes, partially because of where the loan limits are and how attainable some of these properties are for our first-time home buyers. But with that being said, because money is still really cheap, because the payments, when I'm getting buyers for the listings that we have, are still almost the same as what they would pay for in rent. So I think that affordability is higher than what we realized it is, and that people are also transitioning from other markets to this market. I think if the trends continue the way they have been, and there isn't any major changes in catastrophes or anything like that, then I do think that they will hold out. I think it is inevitable for some markets to adjust and to slow down in growth. But what I tell a lot of my clients is if something changes in the market, in the economy, things outside of our control, and prices adjust some, then buy another house. Because if anything, we have seen here that this is where you should be. And that's what you should be aiming toward to have a good retirement. So that's our position.
I think I just like to leave everybody with a comment on this, is that what if you own a $500,000 home and you sold it a year ago? The question I have for everybody, would you be kicking yourself right now because you're $150,000 poorer, plus you didn't have tax benefits last year? So that's what you got to look at here, is what is the loss? And in 2 years, if it continues, you're talking $300,000.
And I have to assume that platform is mostly with investors. So that takes on a whole other ballgame. You have capital gains and a lot of other costs that a regular owner, occupier, seller may be able to, pretty much say that don't matter to them as much. But here in this platform, we really have to look at all the angles and what it really costs a seller to sell their home.
And one other big ticket is you got to pay a commission when you become a seller. As long as you stay a buyer in the investment arena, you never pay a commission. You always get representation from Chris or Tyler, and it costs you nothing. But as soon as you sell that $500,000 home, you just lost $25,000 in equity, and you lost your tax write-off for the next year. Okay, and you're probably going to be hit with capital gains tax unless you do a 1031 exchange. So it's a rude awakening the next year when you file taxes and you look at that. So I ask everybody, look at it ends to the means. Look at where you would be if you did that. Talk to your CPA, then roll it back and say, now is it a good deal? Not just get caught up in the frenzy, like almost an auction where people end up paying more for a property than they could end up paying on the open market. That's what happens in these. So that's why we're very concerned that people don't rush to sell just because the market's hot. There's a lot more to consider. So, okay. Awesome information, guys.
Yes.
Great.
So thank you for sharing that and answering that question. I'm going to go ahead and roll into my segment so we can be respectful of everybody's time tonight.
Okay.
So raising rents. The question we often find here at Management One, and one that I hear in my position with the leasing as well, is should I or shouldn't I raise the rents? And So we're going to talk about that tonight and why we feel the way we do about raising rents. And it's not just about Management One earning more money because we get a higher management fee. So there are two sides of the coin. We have those owners that want to raise rents and those that want to raise it way up here to sticker price. And we'll get into that as well. So there's a theory, it is a myth, but there is a myth that raising rents will cause my resident to move. In my many years with Management One, I've heard this more often than not. And so we did a study. We compiled all of the data for the last 3.5 years of why residents are leaving Management One or leaving the property that they're renting. And out of the 355 residents that have moved, 13 or 3.6% moved because we raised the rent. That means there's a whole lot of people that stayed as the rents went up. So I also hear this quote, I don't want to raise the rent during a pandemic. People are without jobs and they can't afford the rent. Well, as Ron alluded to earlier, 96% of our residents are paying rent and they are paying rental increases as they come. And to be honest, they are, with all the subsidies that have been rolling out while this pandemic, a lot of them are actually earning more money now than they were previously. And so here's what we see every single day. And again, I help with the marketing of properties, and I am seeing that properties are renting at an all-time high and 96% of the residents are paying on time. So we're putting properties on the market higher, hundreds of dollars higher. And this is just one example where we had 200 inquiries in 3 hours. That's not an exaggeration. We were bombarded. I think Tyler was helping us field calls because we had so many calls. And this property rented in 48 hours of hitting the market. So when you choose not to increase rents on lease renewals or as your properties come up for re-rent, you're ultimately robbing yourself of your future retirement. And costs are increasing, some of them 300%. So another project we just recently completed was our maintenance price list. And that's a whole nother topic for another day, but I'll tell you right now, if you've been to Home Depot, you know that lumber today is a lot more expensive than it was in 2019 or the beginning of 2020. And that trickles down to landlords when we're trying to do repairs. And there's an increased cost overall in your maintenance, your property taxes, your HOAs. So if you're not raising rents, that money is coming from somewhere. And at the end of the day, it's coming from your bottom line, your retirement or your checking account. So another thing we were talking about is sticker prices. I did have an owner reach out to me recently and said, I looked on Zillow and my property should be renting for $5,000, not $3,000. So we got to have a conversation about sticker price. So have you ever gone to buy a car and there's this price on the windshield? You're not going to pay that. You're going to negotiate for what the car is really worth. So Zillow is similar to sticker price because we don't know what those properties actually rented for. So let me explain this a little bit. With Zillow, all we see is what landlords, property management companies, you name it, actually want to rent that property for. Then that property rents and they slap a rented sign on there. We don't know what that property actually rented for, if it rented for less than, more than. We don't really know because they don't publish those numbers. The MLS, we do have to say what we rented that property for. However, we don't know the qualifications. Maybe they made a deal, they had bad credit, so they rented it at a higher rent rate because it's a higher risk. What we do know is all the studies that we've done, Zillow, MLS, those kinds of sites tend to be about 10 to 15% higher than what a property actually rents for. So if you go on to Zillow and it says a estimate of $5,000, your property is not going to rent for $5,000. It'll be about 10 to 15% less, and in some cases a little bit more than that. So We personally will use internal data. Number one, that establishes a guideline. Fair housing requires that we qualify everybody the same. So property A, B, and C, their residents qualified the same, meaning we're not making any exceptions to the rule for rent or security deposits. So then we can complete a CRA based on internal data. We also use a very reputable third-party site to compare our rates to. And we do know for them as well, they tend to be a little bit lower than what we actually rent properties for. So if we're listing a property and it's less than what our third-party site says, we know we should probably increase that a little bit. On lease renewals, so that we can establish a fair market value, there's a couple of things that we have to consider. Number one, we conduct an inspection of the property 90 days prior to the lease renewing. So we're not just going to say, oh, the lease is up for renewal, let's go ahead and renew it. If the resident's not taking care of your property, then that's a red flag. And we may not want to renew that lease. We also look at the amount of maintenance costs that your property has had in the last 12 months. Also, why? Is the resident just a nickel and dime, or are there major issues that need to be addressed at your property? We also are limited by the law. So going back to my property should be renting for $5,000 and it's $2,000 under market. Even if we wanted to raise it to $5,000, we can't. And I'll explain that in just a minute. We are also no longer doing 2-year lease renewals. Why? Because the market is going crazy. And by doing a 2-year lease renewal, we are limiting the amount of increase that we can provide for your property and limiting the amount of money that we can make for you. So here's what the law says. If your property is owned in an LLC, a corporation, or a trust, we can only increase the rent 8.6% annually. That does vary by county. Just so happens the 2 counties that we serve, it's 8.6%. If your property is held outside of an LLC, a corporation, or a trust, so it's just a sole proprietor, we can increase it 10% annually. That's the way it is today. We don't know. We don't know. As the laws change, they can renege on that. So we just have to keep that in mind, right? That can change. So at the end of the day, should you raise the rent? In our opinion, the answer is yes, because of all the things that we've stated here tonight. Repairs are going to happen. Improvements are going to need to be done. It's just like on your personal home, right? We've all had to have a water heater go out. We've all had an AC go out. If it happens in your personal home, it's going to happen in your rental property, your investment property. So those things are going to happen. And remember, residents will move out 5 times faster if you're not improving the property as it goes along. So that's the end for me. Do we have any questions for tonight?
I just want to add on a couple of things. One is, in that study we did over the last 3.5 years, keep in mind, 1.5 years of that was during COVID-19. Okay. And so people still went ahead and paid the rental increase, because once they find out, a lot of them aren't really knowledgeable what the market has done. They just go to work like everybody else. You're not in that zone. But as soon as they go into Zillow and they look and see, oh my gosh, if I had to move, I'd have to pay over double what they're increasing. It goes away. So the question is always, well, how do we convince them to go ahead and pay the increase and stay? And that's how we do it. Because as soon as they see it increases on Zillow or MLS or whatever, then immediately they go ahead and comply and stuff. So, but the rental increases, I'll get into that a little bit in my part of the webinar tonight. But just let me say this, it's imperative that you raise that rent, because those repairs are coming and they're going to be a lot of money. If you don't take care of your property, I mean, you get ready to sell it. We just had one owner who's been with us for 30 years. We managed the property. It's a property in Corona, and basically they put a ton of money into it, but they haven't been improving it over the years, okay, structurally and everything else. So we don't want that to happen to you, Okay. And we want your rental property to pay its own way, and it can. And without going into detail, that's what we talked about 3 or 4 months ago when I talked about making sure that you raise the rent and making sure whatever money you're saving on your income taxes, because you own that rental property, or two, that you put that money back into your rental account, because those improvements and repairs, they're on their way.
Yes. Thanks for that addition there, Ron. And so we do have some questions. One gentleman is asking, what about residents that have been there a while? Should we stay month to month? And then what happens if they're not paying due to COVID? So that is a loaded question. Again, we're limited by what the law says right now. So we can only accept partial payments. So 25% unassigned declaration. That's what the law says that they can pay right now. In terms of lease renewals on people that are behind, technically, we are not renewing for another year. It stays month to month. We can enact a rental increase, and they're just going to owe more money. And so unfortunately, that is all we can do right now under the various laws that have been coming out and down the last few months. And it's going to change again because the moratorium was extended to the end of September. CDC is pushing to extend it some more. So there's going to be a lot of hoops to jump through. And so, yeah, unfortunately, we do have those that are taking advantage of the situation, and there's absolutely nothing we can do except for continue to try and collect the money and encourage them to apply for rental assistance as it's available in their areas.
In fact, let me that, because we just got in a couple more big checks, 13, 14, 15,000, where owners were made whole all the way through, one of them all the way through the end of this month, and they were behind several months. So if that should be the case, you go to your lender, you get a forbearance, you push your mortgage payments out, okay? And then we go to work on the back end, which is a lot of work, ladies and gentlemen. It's a tremendous amount of work that our county department has. It isn't one phone call. It's phone calls constantly, not only to the resident, but you, the owner, also to our attorneys. You know, it's just like, it's nonstop. It's mind-boggling how much time, effort, and dollars are thrown towards that. So if you should fall in that area, there is hope and there is light at the end of the tunnel. And we've collected well over 100 or 200,000 for owners under these programs already. So just so you know.
Yes. Okay. So if we didn't get to all your questions, just so we can be mindful of the time, I will, myself or any one of us here on the webinar tonight will be in touch with you tomorrow to answer all those questions. I'm sorry, Christy, did you want to say something?
I just wanted to reiterate and ask again, because I know some people haven't been in all the webinars. Okay, so you cannot give them notice while they are in this process and to move out and get a new renter, correct?
That is correct.
Now, once this moratorium expires, would you be able to immediately give notice?
Currently, no. So there was a law that went into effect in January of 2020, and that is AB 1482. And it includes a clause that is called the just cause eviction, even though you're not evicting. And that was prior to COVID, and that's not going to change. As it stands right now, they do not have plans on changing that. So what that means is there are certain instances that you can give notice. And I just talked to our attorney on this today. But, you know, 3,000-foot explanation is you can ask them to move if you're going to sell. If you or a family member are going to move back into the property, or if your property was condemned by the health department and you need to do renovations. Those are the only three things that can allow a resident to be given notice to vacate. You can't give notice because you don't like the resident or because they're not paying. We can't do that anymore. And that was pre-COVID. And like I said, right now, as it stands today, that law isn't going to dissolve once COVID goes away. So we're still going to be under those guidelines.
Okay, everything is subject to change, ladies and gentlemen. I mean, we really don't know. And if you think it's tough for you, it's tough for us as well, because we live with this stuff daily. I mean, it is more than we've ever seen in 36 years in this industry. So, but we'll come out of it. But it's going to be a little bit longer. So, okay.
All right, that's all on the questions, Ron. So I think you are next.
Okay, very good. Okay, this is basically phase 3. We have one more after this. It'll be next month, will be the final in this series as far as on the Management One's Monopoly game. So last month we went over how we set out your game plan, either be a single family home, a condo, triplex, fourplex, commercial, whatever you have the budget for. We gave you an additional worksheet to figure out what your net worth was, so we can make sure you don't over leverage yourself on your total finances. Hopefully you all went ahead and filled that net worth out. And it's good to see whether you're buying properties or not, just exactly where you are at on your finances. We went over this last week as well, and I'm going to blow this up a little bit so you can read it a little bit better. The client that we had on this, remember, they had $300,000. We took $20,000 and put it into a checking investment savings account. That's a separate rental account, so you don't touch that. And we left $44,000 into a future real estate account. And then in 17, we bought Montego Bay, the investor did. And then in 19, he bought Belicanto for $156,000 down payment. So that disperses that $300,000. And right now, this investor's looking at property number 3. So by using these strategies, it's easy to wrap your head around, well, where's all this money going to go and how's it all going to work? This is how it works right here. It's very simple. You know, it's not rocket science as far as to figure this out. So, but it is good to put it on paper so you can see where that money is going to be. And yes, again, that check investment saving, you do not touch that money. You cannot, because when you need improvements and repairs, it's not going to be there for you if you do. Okay, let's talk about the process for making the property rent ready. So first of all, we went ahead and I maybe identified a property, and your agent, in this case, it'd be Chrissy or Tyler, they would do an initial assessment before you buy it. So they'll walk through the property and they'll be able to see on the major thing. Does it need carpet? Does it need paint? Does it need blinds? Does it need some landscaping? You know, and just in those 4 areas, you're probably talking somewhere around $6,000 to $7,000. So we know right off the bat, you know, and then we'll pull another $1,000 in there for miscellaneous. So we would know before you ever buy the property, this is what you're looking at, plus or minus a little bit, because we're not moving furniture and we're not going to, you know, move the couches and pull the pictures off the wall. So, but primarily that's what you're looking at. And so your agent would do that. Once escrow closes, we will do our first inspection with our property inspector, okay? And when they go out to the property, I know you guys can't read all this, but we go over, it's over 250 items that we look at, and we look at every room, outside, inside. We take photos, we take videos, all in detail, and then you will be sent a copy of this report, okay? Now, once the inspector works up the job estimate, what they do is they send it out to one of our contractors, okay, to go and look at any items that they would need to do maybe an estimate on. We primarily tell them what we will pay them to do the job, and you'll see that in just a second. But there's always oddball things. Maybe it's trimming a tree, or maybe it's just something out of the ordinary that we do need an estimate on. Okay, this is our maintenance price list. This is only about 5 or 6 of the 650 items that are most repaired in a house. 20 years ago, it took us 2 years to develop this price list. I can't tell you how many people wanted to buy it. So no, we do not give out all 650 items to everybody that we manage for. People would love to have this. But what we do is every year, we also update this list. It takes about 150 labor hours every year to methodically go through all the items, all the materials at Home Depot's, Lowe's, etc., supply house, and see what that number is. And the reason we do this is we want to make sure that we are controlling the prices so you don't get gouged on prices. Okay, and that's exactly why we do this. Okay, so let me just go over one item. We're going to use the water heater here. I think you can read that. So in this case, we break it down, the description. It's a plumbing, obviously, labor hours. We give them 2 hours and 30 minutes to put that water heater in. If it takes them 5 hours, you don't have to pay for that. Okay, they do it on their own time. Okay, so the labor cost is $150. Material cost on this 50 gallon here or 40 gallon was $821. They do get a 15% markup because somebody's got to go to the Home Depot. They got to pick it up. They got to take it back to the property. So there's costs involved there. Then you got sales tax. Okay. And then you have a service call. So at the end of the day, you're looking at about $1,221 to install a brand new water heater. And the tank would have a 6-year warranty, but the labor and material on normal things would be 120 days. But we do this breakdown on 650 items that we repair on your property. Okay. And so I don't know of another company nationally that has ever done this. I travel, the country a lot, different conventions, and nobody's even come close to what we do here. And the reason they don't, because it's a monstrous task to take this. But I felt we needed it to make sure we know that you're getting a fair shake and a good value for your dollars that you're investing in repairs in your property. Okay. Now, the next thing of it is, once we have our contractor inspected, we go ahead and we work up a job estimate, which is right here. Again, there could be 50 to 100 items on this job estimate, from painting, cleaning, plumbing, landscaping. And we break it all down exactly what it's going to cost you. And you are sent this before you ever write management want a check to do the work on the property. Okay. And the inspector goes over it in detail, what each thing is being done, if you have questions on anything. And once you and the inspector have agreed on it, then basically the owner approves the work and they send in funds. No, we don't have you mail in funds anymore, okay? Because it takes too long, and every day your property is vacant, it's another $100 every day if you just do the numbers between your house payment, utilities, landscaping, go figure, okay? And so we have you basically take a picture of the check and you send it in just like you see on the Chase commercials, okay? Or you can wire the funds, whatever the case may be, okay? After that, then the work is started. Our contractors, they can complete $1,000 worth of work each day. So if it's a $5,000 job, they can complete that job in 5 days. Most contractors are going to take 3 weeks. So you might think if you have your own contractor, you can do it quicker, but at the same time, you're losing 14 days that your house could be rented. And at $100 a day, that's $1,400 right there. Okay. So just something to consider when you're having your property put in rent-ready condition. When it's all said and done, the inspector that originally inspected it, they go back out to the property. They go through every room. They videotape, and it has audio narration of the video, on the video, excuse me. And so that gives the owner protection against any major things that could come up on the next renter that's going to move into the property. Okay. And trust me, when residents say, well, we didn't do this, all we did is we get them on a Zoom call and we say, well, here's a video before you moved in, and this is what it was. And all of a sudden it goes away. So we've been videotaping, ladies and gentlemen, since 1992. Okay. I don't know how many years that is, but it's a couple decades or more. Okay. And
29.
Just a little side note, before we started videotaping in 1992, we used to take Polaroid pictures. Yes, I know Polaroid's on its way back. Tyler, all you youngsters are really into that now. But anyway, the last year we spent $7,200 in 1991 on Polaroid film of taking pictures of properties. Okay, and then we went to video. Okay, so a little side note there. All right, any questions that we have on making your property rent ready?
Nope, not at this time.
Okay. All right. Let's go on to the next item here. Marketing your property for rent. Okay. Today, yes, we still do put it in all the social media, our website. We email to all our current and past residents. You know, like I said, we've rented over 10,000 properties. So we have a heck of a pipeline that other companies that have been in the business for a couple of years, they don't have that. Because a lot of people say, well, I can put it on the web, just like Management One does. Yes, but they don't have 10,000 past clients that they have a pipeline on. We have that. And that's another reason why your properties rent very, very quickly, not just because it's a hot market, but we're talking quality residents. We're not just talking a resident. Right. Okay. And there's a big difference on how we qualify compared to most, which you're going to see in just a second. Also, we put a sign up on the property for those people who don't want to sign in a normal market. It will reduce your exposure by 25 to 30% longer to get your property rented and get the price that you want. So just understand that when you don't allow us to put a for rent sign there, those are the things that can happen. All right. Next thing is fielding hundreds of leads on potential renters that come in. We can come in on a Monday and we can have over 600 leads waiting to be returned. Okay. It is just unbelievable of the volume that we have. And so we go to work on it first thing, 8 o'clock sharp, we're hitting the bricks there. Okay. Most of all your things come through email, but we still do get a lot of phone calls. Okay. From around, and properties right now, they're actually rented on sight unseen. Basically, renters now a lot of them will sign a waiver that says, I'll take the property, even though I have not even seen the inside. Okay. And they will rent the property. I know it's hard to believe. It's hard for me to believe it. Okay. So I can imagine yourself. But it is the truth. Okay. The next thing is qualifying them. And when we bring on a property, Tyler, tell me if I'm wrong, but this is a big question, right? How do I know that you're going to put a good renter in my property, right? Because that's the biggest fear we all have. I have it too. Because a lot of you own properties in other states, and I have management companies manage for me. I wish they did as good a job as we do. Unfortunately, they don't. But you have to go with what you have in that area. So these are the 10 things that have been vetted and tested over 36 years and 10,000 renters. Okay. Verify income, pretty basic. Verify rental history. What isn't normal is verifying past rental history. On current rental history, they may be telling us whatever we want to hear just to get them out of their property. Okay. But on past rental history, we do two things. We find out the real truth, and we also find out how they left the property, because we found that even though people pay on time, about 35% of them don't leave the property good. Okay. So that number 3 is very, very important. Then we verify the condition of the property. We look at the credit scores, making sure they got more positives than negatives, bankruptcy, foreclosures, evictions. We check those, and also on judgments as well. The last one is number 10, and it's a debt to income ratio. Look at it this way. When we rent somebody a property, your property, and we put a renter in there, we look, and if the rent is $2,000, basically we look at it as a lender. In other words, we're giving you a $24,000 loan at 0% interest, and you're going to repay it at $2,000 a month. So we have to make sure, that their debt ratio, the income ratio, is intact. Because I don't care if somebody's got an 800 FICA, that's great. But if their ratios are off, it's only a matter of a couple of months before they tank, and you're in an eviction. So we look at these items, and the reason of it is because our eviction record speaks for itself, less than 0.5%. Okay. And so we don't have a lot of evictions, but we work harder on the front end to take care of the back end on your behalf. Okay. And in fact, on our full service agreements, if you use our services, basically we pay for the eviction up to $1,200, which covers 98% of all evictions, should the resident default. Maybe they lose their job. That can happen. Okay. All right. Next item is drawing up the lease and legal documents and complying with all the state and federal laws. 36 years ago, we had 1-page lease agreements. Now I don't know how many they are. They're like 8, 9 pages. Okay. But it's unbelievable. I mean, from bed bugs to mold to you name it. I mean, there's so much stuff in these agreements, and we have to constantly be in touch with Fair Housing, which we work with Fair Housing a lot, believe it or not.
Mm-hmm.
Okay. They actually you become one of our best partners, and really working with residents and getting residents to do what they're supposed to do, and so it's really been a great relationship with Fair Housing and Management One. But it is very complex. It's not like the good old days, where you could just draw it up and a pretty simple deal. Unfortunately, that's not the deal. So, okay. Any questions on either of the topics that I covered there, making it rent ready or how we qualify people?
So yeah, we do. Is Management One still seeing that same eviction rate even with COVID and those kinds of things?
Yeah, pretty much. I mean, we've been limited to what evictions we could even file. Obviously with COVID-19, it's a whole different animal. And I think in the last 18 months, I think we've had 6 or 7 that we've actually evicted, and they've been lengthy. Okay. But a lot of those owners those are under eviction under the new program where you can get 100% of your rent if you apply, and we help you do all that, by the way, then, it's not that bad of a deal. And now, even if they've been evicted, it wasn't this way a couple of months ago, but now, even if they've been evicted or not even in the property, you could still go back and ask for those monies. We had one that they were in there 18 months. I think they owed over $50,000 in rent. Okay. And I think we have a very good chance of recouping that. But it's with a lot of work. It's a tremendous amount of work. I mean, it's just more than I can even fathom. So, okay. Anything else that we have there?
No, we don't have any other questions.
Okay. So let's talk about, I'd like to show you proof of what we do. It isn't just hearsay. In fact, it's kind of interesting. Rob and Susan, I met Rob about 35 years ago. Yes, I started real estate when I was 12, so that's why this all works here. Okay, and so, but anyway, he's been with me 35 years. We spent over an hour and a half on the phone today. It was awesome, talk we had going back and all the changes that have taken place over the years. It was just, him and I both said, gosh, we need to do this more often. And it was a great talk. So, but this is 2 of their properties that we manage for them now. One's in Shakespeare and Moreno Valley. It was 3-bedroom, 2.5 bath, 1,500 square feet about. It was bought in 2002, and they paid $190,000 for it. And the rental rate back then was $1,350. Okay. And today it's worth $485,000. Okay, the rental rate is now $1,950. Okay, and the cash per year is over $23,000 on this particular property, and it's free and clear. So the equity is $485,000. Not bad, right? If he'd have sold a year ago, he'd have got probably about $320 or $350. He'd have lost $100 and some thousand had he sold it a year ago. Okay, next property is in Orange County. It's on Badger. As far as when they purchased it, he actually got this, I believe, from his mother, but I'm not certain. However, the same resident has been in there for 13 years, believe it or not. And now the property's worth $750,000. Rental rate is $26.75, about to go up another $200 and some dollars. So the rent's going to be close to probably $2,800, $2,900. And the cash per year right now is a little over $32,000, and the equity, of course, is $750 because they actually own that free and clear as well. So you're seeing some of these clients have been with us for years that it does pay off over the years, and they're now living in Central California. They're enjoying life and their retirement, and so it's just great. I'm super happy for them. It was just kind of icing on the cake. I got to talk to him today for an hour and a half on the call. So here's a summary on Rob and Susan. Is they got $1.2 million in equity on just 2 houses. $1.2 million. Okay. And we already talked about in the first webinar how most people are lucky to have $12,000 at retirement, right? And this is just on 2 properties. Okay. Cash flow per year is $55,000 a year, and they had no debt on the properties. No debt. And Rob and Susan are one, they believe in keeping the rents going. Okay. That's how they look at these things, and good for them, because about 3 years ago on Badger Pass, the photo on the bottom here, he put about $35,000 into it, had to have a whole new roof, a lot of things. The HOA required a lot of things. But the bottom line of it is the houses went up $150,000 from a year ago. Okay. So all those improvements he put in are already paid for. Plus, he didn't have any, as far as in terms of losses, as far as in terms of the repairs there. All right. Next month, we are going to do the final phase. I'll show you how to manage your cash flow on your rental property. And we're going to give you a little sneak peek of our software that you can use to organize your properties, okay, and keep track of them. Because one of the things when you start buying real estate, you got a lot of documents, right? You got grant deeds, you got a rental agreement, you got home warranty, you got this, you got that. You need to have a place that you can put all this. Well, this software, not only will it track all the information on the loan, the interest rate, the payment, the rent, but you can upload all those documents into a file cabinet for that property. So when you get ready to do a financial statement, it's nothing, ladies and gentlemen. It's click, 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 and send it to as many lenders as you want. Okay? Because the biggest reason people don't refi, Chrissy and Tyler, is why? Because they hate the paperwork, right? It's like horrible. It's like, I don't know. It's just beyond belief sometimes what we go through on a refi. But if you have all the paperwork together, you will lower your interest rates a lot more. So, but if you guys want to get started now, as I've indicated in a past webinar, get a hold of Tyler or Chrissia. They'll be more happy to help you and get you launched here. Okay, so Chrissia, back to you.
No, Tyler. Market.
We'll go back to me. All right. So the rental market, as you can see there, it's crazy. I mean, right now, I think in our whole inventory, Kristan, correct me if I'm wrong, but we maybe have under 5 properties.
One.
Okay.
One.
Well, as of today, we have 1 property up for rent. The rest have rented.
Yeah.
That's
so
out of
it
420 houses we manage.
Correct. So it is insane. The reason why we bring that up is 2 reasons. If you have a rental property that we don't already currently manage for whatever reason, or even if it's in a different state, whatever the case is, September going into the fall become the slower months, even in a market that we're in right now, just because of the simple fact school is starting. People have been looking all summer long. So it will die down just a little bit. So if you have a rental property and you haven't put it up for rent yet, definitely contact us right away, or get it up on the market wherever it is. The second thing of it is, if you're looking to buy more investment property or buy your first one, again, kind of now is the time, as we've said in past webinars, and you can get a hold of Chrissy and I. We can go through everything. We can do it fairly quickly. It will take a little bit of upfront work, but that's what we're here for. We can guide you through it. We can do everything that Ron just mentioned today to get it rent ready, get it on the market, and get it rented, so you can start making that retirement for yourself.
I'd like to add on too, Tyler, you talked about kids going back to school. This is a little different this year, right? Because kids haven't been in school. So this year, parents are going to put a lot of time into getting their kids back into school, making sure the checks and balances are there, right? Okay.
Yeah.
So it could even be more of a slowdown than it normally is, because the focus is not on going to be renting a property. The focus is going to be, how's my kids doing?
Exactly. Yeah. One of my cousins out here in California, I believe her husband took work off today because they wanted to take their 2 little girls to school. Thankfully, he has a job, he's secured, but the point of it is to your point, is people are way more focused on taking care of themselves, their children, their family, rather than looking for a house to rent or a house to buy per se, especially just right now specifically.
Yeah. Okay, we have any other questions, Chrisia, that came in?
No, I think that, while we are going to see, like you said, that slowdown, September does dip a little bit. I think it's still preferable than obviously waiting until Christmas and Thanksgiving. So, we have windows, right? We have windows in which we like to strategize the rental of your home, the sale of your home, and we really work around our seasons. Now, this year is a little different, like you were saying, but, and we're working around all the changes. But definitely there is demand for your rental. There is demand for, if you're looking to sell your home. We are noticing, like you said, some trends of slowing, but we haven't come to a complete halt. So, let us know, and we're here to help.
Okay, yep. Chrissy, back to you.
Okay, that actually wraps up our webinar for tonight. So we will see you back here September 15th at 6 o'clock for the final phase, as Ron mentioned. And just to reiterate what he said, even if you can't make it, make sure you register so you can get the replays at a later date. They do come out the next day. So make sure you are registering for those. And if you think of a question later, you can always email one of us and we'll be happy to help you out with that. But other than that, we are done for tonight on time.
Okay, well, thank you, ladies and gentlemen, for attending. We're excited and we're here for you. So give us a call and we will see you next month.
Next month. All right. Bye.
Bye.